Good morning, everybody. Welcome to the morning meeting of the ARMR Investing Virtual Hedge Fund. Thanks for choosing to be a portfolio manager on our desk. This will be a brief morning meeting. Nothing really changed from yesterday. We kind of laid it out chapter and verse yesterday of what we're looking for and how we're going to act, but I'll just go over it real quick with you. And we can share a highlighted stock. So top shelf stock, I have an interest in accumulating. I've already started. And then a couple of selections for some of you who are not buyers of ETFs. Either you can't buy an ETF, you don't like an ETF. We'll go through a couple of charts of what would be at the top of my list to build out a portfolio first and then earn the right to take more risk on down the line. So without further ado, don't forget, you're the risk manager of your own assets. Take whatever you can from this conversation and from other conversations and other research you do, and then be the smart money on your own. You can do it. Just execute your strategy. So let's take a quick look here at our day trading setups yesterday. Yesterday was a consolidation day. It was actually a pretty good day. So you're looking at a 3-minute chart of the S&P and the NASDAQ here. And these are the leaders of the market right now. So here's the gap up. Okay, so, each segment here is 1 day's worth of trading, right? And then this is 1 day's worth of trading. So this was the gap up above the 50-day moving average on the S&P, 50 days down here on the NASDAQ. It went above the 50 the day before. So what I wanted to say to you today, oops, and I'll get to that chart in a minute, but let's just look at the S&P again. We are in something other than a bear market bounce. Don't let the bears, don't let those who've been wrong, all year continue to pound the table. Not necessarily just bears, just people in general who are just constantly afraid. You can't run money if you're constantly afraid. Scared money doesn't make money, is what we say on the desk. Okay? So the way to get over fear is to have a strategy and execute it with stops and be willing to take that risk. If you can't take that risk to the stop, I would suggest two things. Number one, you should not be an investor in the stock market. You can go buy treasury bills at 5.5% and forget it. If you're going to be an investor in the stock market and you can't handle the move to the stop, then my second suggestion is your position size is too big. Figure out a position size where you could put your positions on and walk away. It either hits the stop or you make a lot of money. Get your emotions out of the equation. Okay? So I just wanted to reiterate this morning, like I did yesterday, this is not a bear market bounce. I don't know what this is going to turn into, how high the market, I don't know those things, but I can tell you with a fair amount of certainty, the behavior in the market is something other than just a bear market bounce. You hear me say to you, well, the biggest 2-day rallies occur in a bear market. That's true. That's true. This is 7 days now. NASDAQ's up 7 days in a row. The only animal that could drive the market up like that consistently are institutions, whether they're short covering or taking positions, we don't know. We won't know how long it'll last. Then you have to think about the backdrop of when this is happening. Q4 notoriously is a quarter the market goes up, particularly in a year where the big indexes are already up. Portfolio managers want to get paid, and they're going to mark up their best positions. And they'll do it right to the end of the year. That's just classic. If somebody's afraid of the world, afraid of the market, I get all that. I am too. Probably manifests itself in January next year, if those fears are correct. But right now, we're in that sweet spot, that window. Take a look at what the market has done right here. A perfect shakeout, double bottom at the 200-day moving averages, and a rip back above them. Now, it's early. Market hasn't even broken the downtrend yet. So what I said to you yesterday is this needs to consolidate or come down and close a couple of those gaps. And so for us, what we plan to do is watch the consolidation / retrace. And if it exhibits the correct behavior and we get the follow-on buy trigger, that's when we finish off our exposure. So we start with index exposure, either 50 or 100% of the move of the big cap indexes. And then we do research now and figure out where might we want to go after the correction or consolidation to increase exposure. I'm most comfortable right now in ETFs. I like double the ETFs. I don't want individual stock risk. I don't need it. If I can have 100% of my money to work and double the ETFs to get 200% performance of the market, I'm going to crush it in Q4 if the market rallies. I don't have to guess what stocks are going to go up. I just have to figure out what parts of the market I want exposure to. It starts with the leadership, S&P, NASDAQ. It might, depending on how things unfold, it might spread out to small caps, which have a lot of catching up to do. And generally, they're going to lag, but after the tax loss selling gets out of the way, they can snap back pretty fierce. And it's really hard to tell when the tax loss selling gets out of the way. So everyone says, oh, it's tax loss selling at the end of the year. You won't know when it's over. So you just have to go to algorithms and look for entry points and put positions on. That's it. And you use your stops. If you get on and it hits the stop, you get out. Oops, there's a little more tax loss selling. Does it again, makes a higher low, a double bottom, put the trade back on. Somewhere between now and the end of the year, small caps, I think, if this new rally opportunity, this new risk on opportunity continues to gain momentum, somewhere between now and the end of the year is going to be a great ARMR Algo buy trigger on small caps, and I'll put my money in UWM, which is twice the performance in small caps. Now, I talked to you guys yesterday, if you were on the live desk with us, and we went over, or if you follow me on Twitter, at Brett Rosenthal, I tweeted it out. Along with small caps, are innovative growth stocks that have been beat up all year, and beat up, let's be honest, for the last 2+ years. And what I said to you then, people like to make fun of Cathie Wood, but they're really, there's nothing funny about Cathie Wood. She created a business model where she gives you an opportunity to invest in an ETF that invests in innovative growth. She didn't twist your arm and say, buy it today. It's not her job. It's not her job to tell you that they're going to go through a 2-year bear market. You decide if you want an allocation to innovative growth. If you do, she offers a great alternative. That's it. That's all she is. There'll be times when innovative growth shines and her portfolio is going to go through the roof. And we went over yesterday the top 10 names in this ETF. I like a lot of them. So after the market does whatever it wants to do, consolidate, back and fill, test, whatever, and we get that follow-on entry point, you may see me in my portfolios just own ARK and the small caps right next to the big cap indexes. And there's my exposure for the year. I may do that. Another reason I love doing that is it's easy to hedge. If things start to get ugly out there, I could just short the underlying indexes and I could take off risk any moment I want and still follow the positions to the correct stop. Do you see what I'm saying? It's very hard to hedge a portfolio of 10 to 15 individual stocks. It's almost impossible. So if the market starts to plummet, those 10 or 15 names get destroyed, and there's almost no real way to hedge it. If I need to hedge intraday, I can own those 4 indexes, and I can easily hedge them. And that's why I like that. But let's move on to the next segment of this conversation. For those of you who can't or don't want ETFs, these are the top stocks on the whiteboard for me right now. You have to think Magnificent Seven. And here are the 4 best technical setups with a 5th, which we'll give honorable mention to. And so if I'm not buying the triple Qs or the S&P 500 weighted index, I'd be buying these 5 names. I don't need more than these 5 names. Okay. And it looks pretty much like this. Microsoft is the leader. Okay. In fact, I gave you a picture of this. Here's back to back. There's Microsoft breaking out of what really is an obvious cup and handle. Okay. It's a little bit ugly in the handle, kind of wide and loose, but there's the cup, there's the handle. It's breaking across the tops. That looks great. And then look at Apple. had a huge run, went through its correction, passed the earnings announcement. We all know what it is. The old guard doesn't look so old right now. It looks pretty good. Apple, Microsoft. Grab a pen, piece of paper, write it down. Look at the charts. Apple hasn't even broken out yet. I mean, it has to pop above there. That's a good-looking setup. Okay. Meta continues to be an outperformer, and it's held above that 50-day. Had the shakeout back above it. I like that setup. I think NVIDIA's all the bad news is in NVIDIA, and it's back above the 50. And I would submit to you, since this is the poster child of AI and where most institutions are having a good year this year are focused, they're going to mark this baby right up into its earnings announcement and then maybe even through it. All the concerns and fears about Biden and China and blah, 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 limiting, total bullshit, gives you an opportunity to buy the stock. They can't sell to China. They can't fill the orders they've got. So the technical pattern looks great. There's an easy place to put capital. And then and then Amazon. And then you got to look at Amazon. It's just a nice shakeout below the 200-day and reverse back above it on solid earnings. So if I was to build a portfolio other than ETFs, I would go there first. If I can't make money in those 4 or 5 names, I'm not making money in the rest of the portfolio. Nothing else is going to be working. The leaders are going to have been leading all year, and they're going to lead to the end of the year. Now, they might get whacked in the first week of January. I don't know. But they're going to be supported by institutions that are making money there so they can collect their performance fee. That's just how it is. If I can't make money on those 4 or 5 names, forget it. So that's where I'd go first. I'd earn the right to take more risk. If I can make some money on those names, I'll be working on my whiteboard, looking for other names. And here's the top name on the whiteboard. My favorite individual stock, and I've begun to build a position here. Now, I'm gonna admit to you, it's a bit personal. So that can be dangerous. So I have to use stops, take myself out if it's not working. I can't force my will on the market. But I think after that last earnings announcement, Palantir is probably the best company positioned for its place in time. You know, if you guys are a fan of the Big Lebowski, you know, the dude, you know, there's a time and a place for every man. And the dude in that story, it was his time and it was his place. What I'm telling you is Palantir is the dude. It checks every sexy box. AI, cyber, defense. It's literally the company for its time and place. So that's the big picture. Go look at the last quarter's numbers. They're blowing the doors off earnings expectations. What was it? 600% increase versus a year ago, 7 cents versus a penny. Revenue up about 17%, margins expanding. I mean, they're just built for this situation. So I've begun building a position myself. It gapped up with earnings. These types of stocks should not, if we're at the beginning of another risk on entry point, this gap should not close. This should be a gap and go that takes off and takes the stock out of this pattern. And you can see, look where the stock was. Okay, this is coming out of a huge base. In fact, this base reminds me of GrowGen down here. If you all remember GrowGen, it's so weird. But owning it down here would have been like buying GrowGen under 3. And then it popped up and consolidated on top of that base. And then when it blew out again with earnings, the stock just went berserk. And that was a lousy company. I'm just talking about chart patterns now. This is a perfect chart pattern with the right management team. So I'd like for the stock to come down and test the support, which I think is right around in the 17 and a half area. But if it's not going to get down there, I'm going to be, chipping away, building a position. And if it just breaks out to new highs, I'll be on it completely. Okay. So those are my thoughts for today. I hope you found them helpful. I look forward to working with all of you on the live desk at 9:30 Please do your own due diligence. Make sure whatever you decide fits your risk tolerance and your goals, and then execute your strategy and be the smart money. Have a great day trading, everybody.